You've probably realized by now that there's a lot of indicators out there and it can feel pretty overwhelming, right? The truth is, no single indicator is better or worse than the other. It's all about how we use them together. So in today's video, I'm going to be breaking down the indicators we use here at TTC. If you're new to crypto and want to learn everything you need to know in one place, be sure to hit the like and subscribe button below so you can be notified every time I drop a new video. All right, let's get into it. By the way, happy all-time high again. It's a great day to be in crypto. This indicator is a custom TTC indicator and you can get access to it by grabbing yourself a membership in the link down below. But today I'm going to be walking you through something that is similar and free. The first indicator I'm going to be showing you is market session times by 𝗧𝗿𝗃𝗵. The crypto market is 24/7, but here at TTC we trade on CME time. This indicator helps us to time the market, helps us to clearly and quickly identify where the weekend is, our trading days, and our trading sessions. The market opens on Sunday 5 p.m. New York and closes Friday 5 p.m. New York. No matter where you live or whether you have daylight savings or not, this indicator always shows the correct time regardless. Where you see the blank space represents the weekend, from Friday 5 p.m. New York to market open Sunday 5 p.m. New York. This is when the markets are closed and the market maker isn't on the clock. And if the market makers are on holiday, then best believe that I'm down at the beach working on my turn. Following the weekend, you can see a slightly shaded background combined with Asia, UK, and US. This represents Monday and is repeated for the rest of the week until Friday 5 p.m. New York. This shaded background is what we call the dead gap zone, and this is where the market maker is still off duty but may use this time to set the initial high and low of the day. There is then a 30-minute gap between the dead gap zone and our first trading session of the day, which is Asia, followed by another 30-minute gap, then UK session, another 30-minute gap, and then US session. The gaps are where we can see false moves or stop hunts, and this is the market maker setting up for the next trading session. The trading sessions Asia, UK, and US are when the market makers are active, so this means we are actively trading as well. But why is it so important to know these session times? Well, not only to help us time the market to know when we should and shouldn't be trading, but also because each session, Asia, UK, and US, have their own typical behaviors. To learn more about these session behaviors, consider grabbing yourself a TTC membership, as there is full-blown video and written content. Once US session finishes at 5 p.m. New York, this concludes the trading day, and then this is repeated for the rest of the week. This indicator also gives you the moon cycles, so if we just bring up the setting, you can see that here. You should see a whole bunch of moons pop up on your chart. There's actually a famous quote from JP Morgan saying, "Millionaires don't use astrology, billionaires do." So if it's good enough for billionaires, then it's good enough for us. Astrology is tied into the TBD system. We use it to time the market. There is more about it within the course content on the website. You can choose to turn the moons off just unchecking the box here. You can also choose to have the market session times at the top or bottom of your screen, and you can change the colors of your trading session times, Asia, UK, and US, just by changing the colors here. I've chosen gray, white, and green because it matches the aesthetic of my background. You can also go through and put alerts on the sessions when they're opening or closing. The 2 a.m. check, I forgot to mention that. So the 2 a.m. check, where you see the different colored circle on my Asia session and UK session, this is when we expect an extension. The US session, where there are 3 dots that are colored, this is the first 3 hours of the US session and where we are looking for potential reversals, which is one of the trade setups within TTC called the New York reversal. Now these candles are looking a little dull, so the next indicator we're going to add is PVSRA by 𝗏𝗏𝗃𝗵, and this is going to color your candles according to the volume candles in the PVSRA. When it colors the candles red or green, what it means is that it's an increase of the average of the prior 10 candles to that one. If the candles are magenta or blue, that means it's a 150 50% increase in volume of the average of the prior 10 candles. The green and blue candles are your bullish candles. The red and magenta candles are your bearish candles. So when you look at the PVSRA volume down the bottom, you'll find that the volume will spike a lot higher than the candles prior to it. And why we care about that is because we assume it is the market maker, because retail can't spike that much volume in one candle. Sometimes you'll get a colored candle, but price hasn't moved anywhere. And that's simply because the volume prior to it was extremely low, so it didn't take much to increase the volume in that candle. The next indicator is open interest auto override by trade travel chill. In simple terms, open interest means that both shorts and longs are entering or exiting the market at the same time. Now we know that the market maker is the other side of retail trade, so whenever you sell, they must buy from you and vice versa. The open interest can increase, decrease, or remain unchanged. It can often be used as a way to gauge volatility, especially when combining it with price action. A brief overview of how we combine open interest with price action. If we see price rising and open interest increasing, we would assume this is retail taking long position. Why? Because we also know that market maker is filling the other side of retail's trade. This then builds up the stop losses and potential liquidation levels, which we know market maker comes back for eventually. When open interest is flat, it means that both shorts and longs are being opened and closed and no one is really interested, or they're just trying to pick a direction. This builds stop losses and liquidity both sides. This is also where we may see stop hunts or false moves to get retail to commit. When we see a sharp move down in price and a sharp drop in open interest, that shows us that longs are potentially being liquidated, and we can find this data from high block capital. On smaller time frames, we'll often find that high volatility is accompanied by a decrease in open interest, and this is simply because traders usually do not have enough time to enter positions as the market is moving too quickly up or down. The next indicator we have is EMA, or exponential moving average. Now these EMAs are built into the custom TTC indicator, which you can get access to as well by grabbing a membership using the link down below. But something you can use that is similar and free is the 4 EMA. So you would just head up to indicators, type in 4 EMA and grab this one here. Head into the settings of the indicator and change the length. Now, if I had to choose 4 out of the 5 EMAs that we use, I would choose the 10, 50, 200 and 800 EMAs. You can then head to style and change the color of your EMA. You can also change the thickness and the opacity. The EMAs are significant as they act as dynamic support and resistance levels to the most recent price action. These EMAs move with price, making it relevant to the real trend, the market maker's trend. You might be asking yourself, what do you mean market maker's trend? There's 2 types of trends, the market maker's trend and retail's trend. Retail have a saying, 2 touches to a trend line creates the trend, 3 touches confirms it. That is the market maker intentionally giving you that because retail are praying for that. This is retail's trend. There are 2 ways to trade EMAs. One is to trade in line with the EMAs. So if the EMAs are sloping up and to the right and price action is above the EMA, then you would only be hunting for long positions to trade in line with the trend. If the EMAs are sloping down and to the right and price is below the EMAs, then you would be looking for short position. By the way, another all-time high for Bitcoin as I am recording this video. The other way to trade the EMAs is to trade back into the EMAs. So this is when price has not yet crossed the EMAs, but you are willing to take a position to trade back into them. This is what we call counter trend trading. When the EMAs start to flatten out or go horizontal, there is no trend and we are more than likely consolidating. This is when you would avoid EMA trend trading because 1, there is no trend, and 2, price can often crisscross the EMAs, giving false signals. The link to these indicators will be listed in the description down below, so you can be sure to grab the correct ones.